Great, now I'm gonna bring everything that I just said together for recent round of financing approach. First, as always, we'll start with the definition. This approach determines the value of a company based on the price investors paid for equity in the company's most recent round of fundraising. Essentially, it uses the price at which new shares were sold to investors to estimate the entire company's worth. So basic the logic is, if the recent 10% of share is sold for this price, I know this is 10% and this price, then I know 100% of the share is worth this much. In the universe of business valuation approaches, recent round of financing sits right here with GPC and GT under the market approach umbrella. And if you recall my very old friend Little House, I made 5 of these, so they're no longer just one house, they're now a residence complex. If the most recent house, one of them just got sold for $1 million, the recent round of financing were put the entire residence complex at a valuation of $5 million. And that is 1 million divided by 20%. 20% is just 1/5 of the complex, and that gets you to $5 million. And if this is still not easy to understand, I'll tell the story of my brother when he got paid for his teeth from the tooth fairy. It's something so intuitively understandable, even my brother at 6 could grasp. So when he was 6, this is only like 5 years ago, when he was 6, the market price is $1 per tooth, at least in our neighborhood. And he got paid for his first tooth, and he immediately just like asked me, oh my god, how much more money could I get paid? How many more teeth I could lose in the future? So I told him, yeah, you have, in general, people lose, kids lose 20 baby teeth. You just lost one, you have 19 to go. So if your one tooth is valued at $1, then your entire set of baby teeth is $20 in total. He was very excited. Made $20, easy money. So there you go. That's RF approach in the simplest, ordinary example in our daily life. Now let's dive in a little bit deeper into how does RF approach work step by step. We're again gonna use our lovely old friend, my Mexican satellite company. Let's say the very famous PE firm Sequoia Capital wanted to invest in my company. If you're not familiar with Sequoia Capital, you're probably very familiar with a lot of companies they invest in, such as DoorDash, the delivery company. There's a couple others, like for some reason I'm blinking, but if you just look them up, Sequoia backed startup, they invest a ton of company that changed the world. Let's say December 31st, 2023, Sequoia Capital purchased all of my Series A round 4 million shares in preferred stock at the price of $2.50 per share. Then immediately after the purchase, this recent round of financing, I have my common stock, 1 million shares, let's just say. It's kind of irrelevant how much the purchase price is for my common stock, doesn't matter because it's no longer recent. The most recent one is the Series A. I sold 4 million shares, and the purchase price that Sequoia paid for is $2.50 for each share in the Series A. Recent round of financing, right? And then we're gonna calculate step 2. I'm gonna calculate post-money valuation. And there's 2 options to do that. One is called common stock equivalent. We call it as CSE for short. The second option is to use option pricing model backstop, OPM, we call it for short. Let's focus on common stock equivalent for this video because that's the simpler method. And in the future, I'll make another video for OPM method. A quick note here, there are many other names for common stock equivalent or CSE. So if you hear post-money value method, if you hear IPO scenario or CSE backstop, it's all referring to the same thing. Great. Now let's look at the math. Again, very intuitive. It's price per share times total number of shares from all classes that gives you your equity value. I think the name is kind of self-explanatory. It's basically treating all share classes, whether you're a common stock or preferred A stock, preferred B stock, you're all going to be treated the same. That's why it's called common stock equivalent. I'm going to just treat you as equivalent as common stock. Like same class, same share class. So in my example, $2.50 per share is the agreed price. That's the Sequoia Capital paid. And then after the financing, I have 5 million shares, and that is 4 million shares from Series A and 1 million shares from common stock. So I have 5 million. So when I do this math, I'm going to use 5 million as opposed to 4 million in the equation. And you just multiply two together, boom. And then you have your equity. I have my equity value of $12.5 million. And that's it. Then you're done basically for the post-money calculation of your equity value. To go further, valuation analysts usually determine the pre-money value as well, and it's just a simple subtraction from a math perspective. And then these couple steps require a little bit more professional. I say a little bit more, it's kind of interesting. It's actually a lot more professional judgment. You need to consider adjustment for market or company specific factors. You need to review comparable company valuation as kind of like a sanity check for using your RRF approach. Then you need to consider the impact of future financing rounds that can have on this company. That I will touch on in just a little bit. Key factors to consider for RRF. There are 3 things I want to highlight. They're definitely not the only 3 factors for using RRF approach, but I think those are 3 really important ones I want you to really understand. First is the nature and size of financing. Generally, financing coming from new investors is better indication. That's because when you have new investors, they're the new market participants. They bring the new fresh market perspective to evaluate this company. Secondary transaction or employee traded stocks may not be indicative of fair value, right? Because these are the transactions that have already taken place once. And I put the definition of secondary transaction here for you to read if you're interested. And generally, the sizable financing is a much better indication than a tiny one. I'm going to make up a crazy example. Let's say if we only have information on a tiny investor who bought 0.00001 equity of the company, maybe we should not use RRF approach. It's just too small as a sample to indicate the entire population of shares, the equity value, right? Timing is another thing that's really important, right? This approach is called recent round of financing. It's not called just round of financing. The time between the transaction date and valuation date is very important to consider. We're gonna think about, okay, during this time period, from the last round of financing to today when we're evaluating this company, what has changed? So generally, you don't want too much turmoil to happen in this time period because any major changes in market condition, in the company's performance, and just time passage will cause fluctuation in the accuracy of the evaluation. So market condition changes can be economic downturn, interest rate hike, peer group performance, and changes in subject company performance can be milestone progression or missing target of revenue. And just to be clear, when we say recent, ideally you want the recent round of financing, the data you're using to have happened in the last 2 to 18 months. If the financing happened more than 18 months ago, like say 10 years ago, that's the last time they raised funding, which very rare, but can happen. It probably is not the best indication of value anymore because too much time has passed. It's no longer super relevant for valuation purposes. So quick story time to continue the story of OpenAI. And thank you, OpenAI, for having such a rich news story that literally covered all the examples for my video today. So while all this drama was happening in OpenAI in terms of like who's going to be the CEO, is Sam going to come back, are the engineers going to quit, like what's going on, there was already a planned sale of OpenAI employee shares that would value the startup at about 86 billion, so let's just say 90 billion for easy memory, like could be in jeopardy because the turmoil that's happening with management leadership, with the leadership, right? And people were panicking, like, is this gonna happen? Is this not gonna happen? Even if the sale did go through, this could impact their valuation, right? Because who would want to still pay for extremely high premium for a company that's not really stable and not running smoothly? There's a lot of friction. But thankfully, as we all know, like Sam was reinstated as the CEO and they had a new board. Everything came to a more stable, situation. And then OpenAI decided to extend their tender offer shares to January 5th, 2024 to give people more time to think about it and more investor to think about it and participate as well. And then all is well that ends well. OpenAI is now at the end of last year, 2023. They're even seeking a higher valuation through a new founding round, which is gonna put them in the $100 billion revenue, $100 billion valuation. Cool story. So I guess in the end, it doesn't really impact OpenAI that much. So good for them. And for us as well, who enjoy the benefits of GPT. Last but not least is the capital structure, right? This is why I spent so much time talking about the simple capital structure versus complex capital structure. This sometimes helps determine which methods to use for RRF approach. Do you use common stock equivalent? Do you use OPM? And here's some very high level gross generalization for easy memory for you to understand. If the capital structure is simple, common stock equivalent is more likely to be used because it's easy math. If the capital structure is complex, then clients paying a lot of money. And just as a reminder, a lot of this valuation service is very costly. So OPM may be likely to be used if the clients pay a lot of money for valuation analysts to do the calculation, verify, check assumption, and so forth, and the capital structure is really complex, OPM might be better suited. If there's already an anticipated timing of exit just means investors selling the stake of the company, like leaving the company behind, moving on to next investment. It can take the form of selling to another investor or selling the stock at IPO and all that stuff. If there's an anticipated timing, the OPM methods is more likely to be used because this is the method that is more forward-looking. This is the method that's forward-looking. Common stock equivalent only looks at as if today is the day you're gonna sell your business. And there's a couple more questions. I won't read it, just for you to read on your own time. To bring home this point, like valuation analysts can use, when they use recent round of financing approach, they can use just common stock equivalent method, they can use just OPM method, or they can use a combo of both. It really depends on the situation and how much time or compute power they have on their team. All right, so now we talk about some key consideration for using RF. We are gonna talk about RF compared with other approaches. What's the pros and cons? Why would people use recent round of financing over GPC or GT and DCF of these other approaches? And for the scope of this video, I'm only going to focusing on comparing RF using common stock equivalent method within RF approach. And I will have another video for OPM method using RF approach. So the pros, RF is especially useful for early stage companies that have not yet generating significant revenue or profits. So if you have already watched GPC video or the GT video, you know both would require you to select a valuation metric to compare companies, right? But if you're a company that is in loss, you don't have revenue, you're super early on, in your company growth stage, you don't have any of these things, or you may be in negative, your net loss, you're in you have zero profit or negative. In that case, when you select those using GBC, GT, you may get a negative value, which is not what we want. And that's when RF comes in. So you can use the most recent round financing to establish a more realistic intrinsic value of the company. Second, is super easy to understand conceptually, right? Like if you most recent round sold for this much, if you're $10 for 10% shares, and then 100% shares $100. Easy math. And last but not least, easy math, right? It's very cost-effective method, which is one of the reasons why like the common stock equivalent a lot of time is preferred over OPM, especially when the clients are not paying enough money, or you don't have a good calculation software or like Excel model to do the more complex calculation that is OPM. So what are the cons? Recent round of financing rounds can be influenced by market sentiment and investor demand, which do not always reflect the intrinsic value of the company. And OpenAI, again, is a good case in point, because they recently just, like I mentioned before, they just recently raised another round of money that put their valuation over $90 billion. Their revenue their analyzed revenue, I think, just passed $1 billion. And what does that mean? That means for all the investors holding their stock, or investors who want to buy their pre-IPO stock, they're paying $90 for $1 that OpenAI is generating. So the valuation to revenue ratio isn't really that great. There's definitely so much like market hype, sentiment, excitement around the AI technology and wanting to be position themselves as the leading like a participant of a leading company, leading startup. So people are willing to pay that premium. But does that really reflect the intrinsic value of the company? Yeah, it depends on how you think about it. Like different investors have different perspective, and at the end of the day, like all our opinions are just biases. So that's the slight downfall of recent round of financing. It's also influenced by investor demand, demand and supply, right? If more people want it, it drives up the price, and sometimes the price is already like detached from the intrinsic value of the company. CSE is not a forward-looking method. What that means is if you know if the company is gonna IPO in 5 years, using common stock equivalent method within RF approach, you cannot factor in the 5 years down the road you're gonna IPO. But guess what? The other method, option pricing model backsolve, is a forward-looking method and can factor in future value at exit. So valuation analysts have the flexibility to choose between OPM and CSE depending on their need and the circumstances of the valuation. And I will talk a little bit more about OPM in the next video. I know there's a lot of content for recent round of financing, but I hope all the investment that you put in to understand the difference between shareholders and creditors, the difference between common stock, preferred stock, bonds, simple capital structure versus complex capital structure, they're definitely going to pay off as you continue to watch more videos and grow your knowledge in accounting and finance. And I'll see you in the next video. And as always, if you have questions, please leave a comment and subscribe and like. Thank you so much for your support, and thank you for watching. And I'm gonna put my sunglasses off.